the reason why I think we could see 8% yields or mortgage rates, probably even back to like 10%. And why do I say back to 10%? Well, because back in the early 90s, people were paying 12, 14% on their mortgages. Tuesday, May 23rd, 2023, Maneco 64, home of alternative economics and contrarian views. We're going to look at UK bond yields today and mortgage rates for that matter. And things don't look good to me. And am I being one pushing insidious declinism? And what is that? Well, that's what Jeremy Hunt is trying to come out with right now, trying to talk up the economy. This is what he said yesterday. Let's not talk ourselves down or allow a corrosive and inaccurate narrative about Britain to become a self-fulfilling prophecy. Conservatives know in our DNA that we are a great country with a bright future if we choose it. And he wrote in the Telegraph, it says, insidious declinism about Britain risks becoming a self-fulfilling prophecy. And I replied, I said, it's all about maths and not any kind of insidious declinism. When the government and consumers and businesses, with the help of the Bank of England, borrow and spend trillions at manipulated rates for over a decade, there comes a time when it's time to pay the piper. So I do agree with Jeremy Hunt. This country could be a great country. It has the potential. The people in this country are generally very hardworking, very well educated, very polite. And we have the language. Don't forget, the English language is a big asset in worldwide for business. But unfortunately, as I said, you have to look at the maths. And this is what we're going to look at today, because I'm concerned that we could see interest rates rise to at least 8% in the next couple of years. Can you imagine how bad that will be for those with big mortgages, for those who are thinking of renewing their mortgages that they took in 2020, 2021? Yes, we're going to look at that. Before I start, I like to say I'm not just coming here for those of you who are new to the channel and just like making these predictions. I've been warning about this since I started making videos on my channel back in late 2015. So let's go through some of the videos where I warned what was going to happen. This was in 2016, and just around the time of the referendum for whether to leave or not leave the EU. And I said Brexit will be used as a scapegoat for deliberate UK inflationary policy. So I've been warning about that. And because I'm not saying Brexit has been a success, but we would have had inflation no matter what, and no matter who would have been in power. I've got also playlists about the UK. I've got one called the UK Debt Time Bomb, and there's quite a few videos there. And I go back to the early 1900s with the beginning of like the state pension and also the welfare state, and how the demographics are going totally against funding that, and why the country needs more and more debt. I go on about the fact that we took on massive amounts of debt to bail out the banks in 08-09, and not just the banks, but to bail out homeowners, because they were up to here in debt in terms of mortgage. So there is a way out, but unfortunately, politicians like Jeremy Hunt and even the other side, Labour, they'll never tell you the truth, because if they did, they'd lose the next election, or they wouldn't win the next election. So they have to keep trying to tell you that everything's fine while it isn't. So the other thing I've been talking about, and this is more to do with international markets, and for those of you who don't know, I worked in the city of London in the bond markets, government bond markets, which set interest rates. The Bank of England does set the base rate, but the market itself sets, and investors set bond yields, government bond yields, gilt yields. And I've been talking about the fact that interest rates were not going to stay low forever. You probably heard from friends talking about buying a property, or if you have friends that are into buy to let, who have taken a lot of debt. And I've heard this, maybe let me know if you haven't, but I'm sure you have. A lot of people say, well, interest rates will never go up that much, and there was always that attitude, especially from the younger generation, people who didn't see rates in double digits, maybe in the late 80s, early 90s, and even in the 70s. I think mortgage rates were up around 20% at one point. And they always thought it was going to stay low. So I've made videos about the fact that the cyclical nature of bonds were telling me that we're near the end of a long-term bull market in bonds. A bull market in bonds means that interest rates remain low. So because when bond prices go up, interest rates go down, or yields go down. So I made a video back in late 2020. And this is when rates are really low because the government and the Bank of England, they did massive amounts of QE and government fiscal spending. They scratched each other's backs. And I said the secular bond bull market and the great conjunction of 2020. And I went on to say that there's a very good chance that the 40-year bond bull market, or the 40-year trend of lower rates and easy to borrow, easy mortgage markets and higher house prices, was probably about to end. And it's interesting because if we look at the UK gilt yield, the 2-year gilt, why the 2-year gilt? Well, because the swaps market that sets a lot of the mortgages, the 2-year mortgages and 5-year mortgages, they're based on the 2-year gilt yield. So this was back in my warning about the bond market was back in late 2020, and believe it or not, back in late 2020 and early 2021, the 2-year gilt yield was negative. So you were getting paid in nominal terms, so to speak, to borrow money, and it stayed below 0.2% up until the end of 2021, and then eventually it started picking up, as you can see here. So there's a lot of you out there who have their mortgages now, the 2-year mortgages that are coming due because you took on a very low mortgage. Hopefully you didn't take on too much debt. And I've read articles, people saying, oh, I'm only going to do it for 2 years because maybe by then interest rates will have come down. Well, I've got bad news for you, and that's just my opinion. You could be right, but I've followed these markets. I've looked at technical analysis. I'm not sure Jeremy Hunt knows any of this. I'm not sure people even at the Bank of England know much of this. I've heard that they were clueless back during the '08 crisis from people that were even in contact with them, trying to explain to them what was going on with the subprime. So these are things that they're not looking at, and I'm looking at. So back in the summer of last year, around July, August time, I was warning as well about this, that rates were starting to pick up and we could have some kind of crisis in the autumn. The autumn. Why the autumn? And September, October time? Well, because historically that's when we have these crises. We had the ERM crisis in 1992. That was in September when George Soros broke the Bank of England. Back in 1931, this country defaulted and left the gold standard back in September of 1931. Why do I say default? Well, because it had promised countries that held UK sterling debt that it was as good as gold. So by leaving the gold standard, that meant, you're going to get the paper, but you're not going to get payment in real money. So that's why I warned that. And even if you look at the 10-year gilt yield, back in, let's say, July 2020, it was as low as 0.07. Yes. And now we're above 4%. So what I wanted to show you, the reason why I think we could see 8% yields or mortgage rates, probably even back to like 10%. And why do I say back to 10%? Well, because back in the early 90s, people were paying 12, 14% on their mortgages. And you might ask, how could they do that? Well, because the markets were not as manipulated back then. People's wages had kind of kept up with house prices, and they could afford it, and they didn't have to leverage as much. But nowadays, house prices are so high in compared to people's wages that people have had to leverage themselves, i.e., they've had to take on a lot of debt to buy a place. We're hearing that mortgage companies are thinking of offering 100% mortgages, which is a bad sign. So here we've got technical analysis, and you might think this is just gobbledygook or whatever, or voodoo economics, but believe me, it does work. And sometimes, yes, the powers that be, the central banks and the governments, will try to manipulate it, which they did kind of last year when the Bank of England came in, when everything was imploding. The defined benefits pension industry almost collapsed because they were leveraged. That's the other thing I haven't covered. The derivatives. I have a derivatives file, a playlist. Go look at that. And the majority of derivatives are side bets by the City of London, by the hedge funds, by investment banks, even by banks, even by pension funds, on the underlying value of assets, and in this case, on bonds. And when bond prices when the market goes crazy, when bond prices spike or drop very quickly, like they did last year, they dropped, and we saw a yield spike. It creates accidents, and the defined benefit pension LDI crisis was something that popped up out of that. And I'm sure there's going to be something new popping up that we don't know about to do with derivatives. But as you can see here, we bottomed there in late 2020, 2021. This is the 10-year gilt. So it didn't get to negative, but this is the one I'm going to look at. I could have used the 2-year, but it doesn't really make much difference, I would say. So you can see that we topped last year. Bank of England came in and they did QE. What does QE mean? Well, they just create money out of thin air, bank money out of thin air. and they go in the markets and start buying the gilts, and that drives other bonds higher as well, like mortgage bonds, corporate bonds, and it drives interest rates lower. But as you can see here, we've had a a respite for the last 9 months or so, but now yields are starting to spike out of this little flag or triangle, if you want to call it. And usually in technical analysis, when you've had a trend that's been up, as we talked about, since early 2021, and then rested a little bit here like it has, that's called a continuation chart. And this is the consolidation here, and usually 3 out of 4 times after the consolidation the trend resumes. Yes, there is a chance that rates might not make new highs here and not go to that 8% plus level that I see here. Why did I pick that? Well, because usually when the trend resumes, the market goes the same amount of distance that it did in the first leg. So you just measure it. It's just a matter of measuring it. So the only way out, I think, of this would be for the Bank of England to come out and start massive QE again. But they would lose all credibility, and the pound would drop even more. Unless, of course, there is some kind of crisis that basically, like we had in 2020, where it gives them an excuse to come in and just print £500 billion of paper and allow the government to borrow even more. So that's the only way I see it. But even if there is a crisis where they could justify more QE, the pound is going to really suffer in terms of purchasing power. And of course, they might try to doctor the CPI and RPI numbers. But what I mean by that is that you will see the pound lose a lot of value versus real things, hard assets, which is already doing. And that's why I've been stacking or purchasing or exchanging my fiat currency, which is basically the other side of this debt, for real money, gold and silver. And many of you have not followed my advice, but you've done your homework and you decided to do it too. So for those of you who haven't and are thinking about it, I have referrals. I have bullion dealers I work with, and you can look below in the description. I have affiliates here in the UK and also in the US, for those of you who are in the US. But one thing I forgot to almost tell you as well is that the Bank of England is in deep trouble, and that's gonna actually be deep trouble for us taxpayers in the UK and the UK Treasury, because when they started doing QE back in 2008 and 9, and it was supposed to be just temporary, right, QE, the deal was that any profit that the Bank of England made on the QE, on the bonds that it bought after they matured, they'd have to send those profits to the Treasury. And I'm sure the geniuses at the Bank of England and the Treasury never thought that we'd see interest rates rising as quickly as they're now, because yeah, they thought inflation was transitory. And there's still many out there who think rates are going to go back down. But what happens now is, as yields go up, the Bank of England is losing a lot of money because it's holding all these bonds that are underwater. And the rules say that the Treasury or the taxpayer has to compensate the Bank of England for these losses. And I think last year the Treasury sent billions of pounds. It could be in the I forgot the number, but if we see this development here in the gilt market, in the bond market, where yields keep rising and go to 8%. And when do I think it could be up there if everything goes according to this technical plan? Well, you measure the time as well from the first leg. It's giving me 2025. So back to the people who are thinking of fixing their mortgages for just 2 years. Well, 2023 plus 2, 2025. And you get to 2025, it's even worse. So what would I be doing if I had to get a mortgage to buy a place or to buy a new place? Well, I would think again. I would, if possibly, not try to get too much of a big mortgage. Maybe not buy as big a place. Maybe move somewhere else. Weigh the advantages and disadvantages of moving a bit further away. Whether you can work from home and buy something cheaper somewhere else, because I don't see any way out. And even if they do keep rates low, the cost of living is going to go through the roof because the pound is going to be worth a lot less. So I'm not negative. I'm not an insidious declinist. I'm just a realist. And when you keep, as I replied to Jeremy Hunt, when you keep living beyond your means like that and you think that there's no tomorrow, it's a very dangerous place to be. And we're definitely going to see, the piper, we're going to pay the piper. That's what we're doing now. So there you go. With that, let's quickly look at where the markets are this morning. It's 8:25 a.m. London time. We've got spot gold at $19.57. It's down $15. So there's another chance for those of you who have extra fiat currency savings, I would say, to keep on protecting or insuring yourself against this coming debt tsunami, interest rate spike, as I see. Anyway, the high's been 1973, and we're right near the lows here. Silver is at 23.30. It's down 1.3%. Again, I'm still buying silver and gold. Yes, if you understand what's going on, hopefully you will see why it's so important to have a little bit of it. What about the stock markets? Well, they're pretty much unchanged. Looks like Rudy's interested in the currencies. The pound is down 0.25%, just above 124. The euro is down 0.2, just below 108. The dollar is down slightly versus the yen, 138.50. And let's have a look here. The dollar is up 0.25% versus the yuan at 706. Aussie dollar is down a third at 66.32. The dollar is unchanged versus the Canadian dollar, 135.12. And the Kiwi dollar is down a third of a percent at 62.66. To the commodities. WTI crude is unchanged, 72.02. Brent is unchanged as well, just below 76. Platinum is down $10, just above 1,060. And high-grade copper is down about 1.3% at 364. So yeah, we're seeing a little bit of the commodities here come off. I still think, just like last year, commodities, precious metals, hard assets are going to continue to outperform all the paper markets like bonds and stocks, mainly because I see interest rates a lot higher and central banks losing control of it. And when that happens, the value of those bond and stock securities go down. Just quickly look at the bond market. Let's have a look at the what the gilt yields are doing this morning. Yesterday wasn't a good day. We saw a big spike in yields. Well, today it's continuing. Now the 2-year gilt yields is up 5 basis points. It's at 4.1, 4.10, and the 10-year is up another 6 basis points at 4.13. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.